Good morning, good evening, good afternoon, traders. Thank you guys so much for joining us here at TradeDelicious. I'm your host for the Learning Hub, Aaron, and I'm super excited to bring you something that I'm surprised we're not talking about more. It's really important to the markets, and I think it'll be a great opportunity for Forex traders, equities traders, futures traders, any kind of traders. It'll offer you some value. I hope you get some value out of it. Let's jump right into it. What am I talking about? I'm talking about the Federal Reserve Bank stress test. It's something that we don't talk about often because it's something that only comes out annually. Usually it comes out in the second quarter of the year. It doesn't always, but for the most part it comes out the end of June every year. And it's something that is a part of a larger group of reports that the Federal Reserve supplies to the public to basically update the public on how they're doing on the key areas that they focus on, those key areas being the strength of the economy, the strength of the labor market, and the fight against inflation, right? This report is released, of course, at the end of the second fiscal quarter of the year, so usually at the end of June, and the data is reported directly by the Federal Reserve Bank of the United States of America. Why trust this report? Look, anyone that's been trading for a while may have heard some of the news concerning a couple of banks that went belly up in the past few years. Lehman Brothers, Credit Suisse, SVB, any of those ring a bell? Well, unfortunately, the Federal Reserve on several occasions has said that, hey, this bank is fine. This bank can withstand the stress of horrible economic conditions. And that's where this report is where the Federal Reserve has said these things. Sometimes people get it wrong. That's the long and short of it. With any of these events that we talk about, I always ask that you take everything with a bit of a grain of salt. And if you want to use these kinds of reports in order to create a thesis like I do in my own trading, I always suggest that you think a little bit about using this kind of data as a support for a thesis, not a foundation. Now I got the disclaimer out of the way. Let's talk a little bit about the value of this test because it's exciting. You know, these models use publicly available data in order to determine the strength of each bank assessed and see how well it could deal with adverse economic conditions. Usually there are about 34 banks that are tested, and of those 34 banks, several of them are massive, over several $100 billion in value and assets. So it's incredibly important that we know how strong these banks are and whether or not they can handle horrible economic situations. This data includes large banks, capital ratios, pre-tax income, losses, revenue, etc., etc. And the big benefit for banks in this portion of things is if they pass these tests, they're allowed to increase their dividend or create stock buybacks, both of which would be magnificent for the company. Shareholders would be super happy to have either. So there's a real incentive for banks to perform in these kinds of stress tests. The banks involved. A little bit more details about each of the banks. These are all of the banks that were used in 2022's stress test. Each bank is categorized by size and organized as such. Banks with assets between 100 and 250 billion only participate once every other year because they're small banks. Believe it or not, I wouldn't mind being small, right? So the category 1 banks are the big boys. These are banks with over $700 billion in assets. They're getting closer to $1 trillion in assets. They're global, systematically important banks, GSIBs. Category 2 is a little bit smaller. You know, they have a minimum of $700 billion in assets or $75 billion in cross-jurisdictional activity. That's a whole nother can of worms I'm not going to open, but all it means is that they have a ton of money. They're just not big enough to be globally important to the total system. Category 3 banks have at least $250 billion in total assets, and Category 4 banks have at least $100 billion in assets. They're tiny. They're having a rough go at it. It's hard to be a Category 4 bank, but that's the crux, the gist of the banks that are used in this assessment. They include big names like JP Morgan, and they include names that you may never heard of, like KeyCorp. The strength is the really important part of the discussion here. We're trying to see how strong these banks are under horrible economic conditions, right? So each bank is tested through a collection of models. Each model varies in difficulty, but most often the most severe is used as the benchmark, and that's the report that we hear the most details about. So after the models are complete, we're then given estimates on a slew of data points indicating how strong or weak the bank would be in really tough economic conditions. Again, these areas include things like capital ratios, loan losses, risk-weighted assets, etc. These areas are always changing for the stress test depending upon what's going on in the economy. So each category is not always the same. But the data is the data is the data. If it's bad, it's bad, right? Obviously, there is going to be a benchmark for how well the bank should perform. There has to be a benchmark for making sure that it can pass the Federal Reserve standards. This is Schwab's information from this past year in 2022. They have a collection of minimums, as you can see here on this right side of the stress capital ratio side, and they have failed in each of these 6 areas of this one portion of the stress test. Now stay with me because this is incredibly important. Because they failed, they were not allowed to raise their dividends or produce stock buybacks. Obviously, this is incredibly bearish for the stock, and this is starting to get into how you can create opportunities by looking at this kind of report. There are other banks that did very well in this situation, and therefore they will be able to create bullish pressure on the asset. This is incredibly important. It's going to be super valuable, especially to equities traders. I'll get to other traders here soon. But to expand a little bit about what the most severe model can look like, think of SVB in March of 2023. Think of Lehman Brothers in 2008. Rough situations. In each situation, there are models that the Federal Reserve has created based off of the scenarios that have occurred in the past, and that they're applying to banks moving forward in order to make sure these types of issues do not continually repeat themselves, right? Now, let's get to the nitty-gritty. We're all traders here. We're all investors. We're all looking to make a quick buck, or a long-term buck, so to speak. How do you make money off of this thing, right? I talked a little bit about how an equities trader could do it. What about futures? What about Forex? What about a longer-term investor? Well, as a part of the stress test, it doesn't just look at individual banks and how they perform under these models. It looks at the economy as a whole, the financial market as a whole. So it looks at areas that would be adversely affected by rough economic conditions. In this particular model that they produced, this severe model, they focused a lot on unemployment. Unemployment was to grow very quickly in this particular model and cause things like defaults for loans. Well, if loans default, who's left on the hook for that money? The bank. The bank's losing the money that they lent out in hopes to get back with interest. As you can see from this chart here, there are several conditions, there are several categories, that include some variety of loans, right? Other loans, commercial real estate loans, and domestic and otherwise, commercial and industrial loans, and then other consumer loans make up far more than half of the conversation that we have here, right? So when you look at that and you see that of the losses in this particular model, and this is looking at all the potential losses that a bank can have, it's very heavily focused on loans. Don't forget these kinds of liens and everything of that nature, but these loans make up a significant amount. That's 12, 24, 44, 52%. This is significant here. So obviously, banks that hold abnormally large debt in these vital areas, such as commercial real estate, for example, may be at significant risk. They may be at significantly more risk than banks that don't have as much in the way of loan debt on their balance sheets. We can break down a little bit more into something like commercial real estate. With the commercial real estate issues, we've seen time and time again, companies like the New York Times, the Wall Street Journal, Bloomberg have reported that there are really bad conditions potentially on the horizon for banks that are holding a lot of commercial loans. We're seeing a lot of concern about what happens when these loans come due. We'll see several collections of loans, several billions of dollars, nearly trillions of dollars come due for refinancing. This is an industry that is very common for people to refinance on a certain time period, 5, 10, 15 years, and usually they just refinance and it goes to whatever rate is the going rate at the time. As we've been discussing so often on this channel, interest rates have gone ballistic just in the past 9 months. So a lot of these loans, that are 2%, 3%, 4% loans, will now double, triple, quadruple in price, making it so several banks will have inevitably several of their customers, large and small, defaulting on their loans. Not good. This type of situation is exactly the perfect storm that could create something like another SVB, another Lehman Brothers, another Credit Suisse. Now, how do you trade this thing? Like I said, everybody gets an opportunity, right? So obviously, if you're trading direct equities, you can look at the specific names, the specific ETFs that did perform well or did not perform well according to the criteria given by the Federal Reserve. If you're a Forex trader, you can start to look for coinciding weaknesses in the US dollar. Let's face it, when everything was going crazy with SVB, when everything was happening with Lehman Brothers, a bank is a representation of a country's economy. If you have large banks or several banks that are performing very poorly at a given time, that's going to inevitably affect the dollar and vice versa. So you could be looking at potentially going long on a pair that has the dollar on the back end, the euro dollar, the pound yen, something like that, right? The pound dollar, forgive me. And then in the futures, we can start to look for strength in the shiny stuff, things like commodities. When banks start to struggle, we start to see a lot of investors flee towards risk-off assets, something like gold, something like silver. There's an opportunity for everyone here, and there are different ways that we can take advantage of this report. Keep in mind that the report includes a lot of data, so you can look through it, you can comb through it, and find a lot of opportunities for yourself. But the most important things to remember are, one, this is something that's measuring the strength and health of banks. So if banks are failing, it's an obvious opportunity to short banks in some capacity, whether that be through the US dollar, whether that be through the banks themselves, doesn't matter. The second item to keep in mind is simply that this report is looking at adverse economic conditions that eventually will happen. The data I showed you from 2022 talking about commercial loans is something that we are talking about ad nauseum in 2023. And this is not something that will just happen this year. This is something that will happen for years to come as well. If you're watching this in 2030 and you look at the stress test from 2029, I guarantee you there will be some breadcrumbs in there that could potentially lead to high quality trading opportunities that would not have support if not for your knowledge on these types of reports. That's all I got for you. Thank you so much again for joining us here at TradeDelicious. It's always so exciting for me to share this stuff with you guys. I get such a kick out of going through these types of opportunities and breaking these things down for you, and honestly reviewing a lot of this information for myself I'm so grateful for each and every one of you guys participating and just learning. This is so great. It's going to positively affect your trading and positively affect your mindset as you go into the markets, understanding more, not just about the trading side, but about the macroeconomic side. I hope you have a magnificent rest of your day. As always, please trade well and trade delicious. I'll see you.